It is one of the most common money fears in America. You fall behind on your taxes, and one day the IRS shows up, changes the locks, and takes your house. It is a real fear, and it is not entirely wrong. But the full truth is more specific and, honestly, more reassuring than the nightmare. So, let's walk through exactly what the IRS can do, step by step, and find the one line even they cannot cross without permission. First, the big picture. The IRS is the most powerful collection agency in the country. A regular creditor, like a credit card company, has to sue you, win a judgment in court, and only then start collecting. The IRS mostly skips that. It can attach claims to your property and seize your money largely on its own authority. That is a genuinely enormous power, and it is why this fear exists in the first place. But that same power comes wrapped in a specific set of rules, notices, and rights. And when it comes to your home, the rules get stricter than for almost anything else you own. To see why, we have to separate three words that people use as if they mean the same thing. They do not. A lien is not a levy, and a levy is not a seizure of your house. Start with the lien. A federal tax lien is a legal claim against your property to secure a debt. Think of it less like a repossession and more like a flag planted on everything you own. Once the IRS formally assesses the tax, sends you a bill, and you still do not pay, the lien arises automatically, by law, reaching all the way back to the assessment date. It covers your house, your car, your bank accounts, even property you buy later. Here's the key thing about a lien. It does not take anything. Nobody is coming to your door. The lien is the government getting in line. If you sell the house, anyone whose claim predates the government's filed lien, most commonly your mortgage lender, gets paid first. The tax line then reaches whatever equity is left before you do. The notice of federal tax line is also public, which is why a tax debt can quietly wreck your credit and your ability to borrow. So, a lien is a claim. It is the IRS saying, this property answers for your debt, and we have a stake in it. Frustrating, damaging, but static. It just sits there. The thing people are actually afraid of, the part where property physically changes hands, has a different name. That is the levy. A levy is the actual seizure. If a lien is the claim, the levy is the government reaching out and taking the thing to satisfy the debt. And the IRS has a menu of what it can levy, roughly in order of how easy each one is. The easiest targets are money that is already sitting still or flowing toward you. The IRS can levy your bank account, freezing and sweeping the balance. It can garnish your wages, taking a chunk of every paycheck straight from your employer before you ever see it. It can even reach Social Security payments and some retirement income. For most people who owe, this is where the story actually ends. The bank levy and the wage garnishment do the work, and the house is never touched. Physical property is further down the menu, precisely because it is harder and messier. The IRS can seize and sell a car, a boat, a business asset, or real estate. But seizing a thing, storing it, advertising it, and auctioning it is slow and expensive for the government. It is the option of last resort, not first instinct. And your home sits at the very bottom of that list, behind a wall of extra protections. Before any levy, though, you are owed a warning and a chance to fight. This is the part of the process most people do not know exists, and it matters. In most cases, the IRS cannot simply take your paycheck or your bank account out of the blue. By law, it usually has to warn you first. There are a few narrow exceptions, like when it believes you are about to flee or hide your money. But in the ordinary case, notice comes before the levy. The IRS must send a final notice of intent to levy, along with a notice of your right to a hearing. From the date of that notice, it generally cannot levy for 30 days. That window is not a formality. It is your opening to act, to pay, to set up a payment plan, or to formally challenge the whole thing. Inside that window, you can request what is called a collection due process hearing. In plain English, that is your right to take your case to the IRS Office of Appeals, an office separate from the collectors, before anything is seized. You can propose an alternative like an installment plan, claim a levy would be an unfair hardship, and if you never got an earlier chance to dispute the amount, argue you do not owe it at all. And if appeals rules against you, you can take it to the United States Tax Court. So, the picture is already very different from the nightmare. Nobody is kicking down a door on a surprise afternoon. There is a paper trail, a mandatory waiting period, and a built-in right to a hearing in front of a different set of eyes. For most tax debts, this is the whole game, and it never gets anywhere near your front door. Now to the house itself, because the law treats your home differently from everything else, on purpose. Certain property is simply exempt from levy, meaning off-limits. The law protects a basic amount of your wages, some benefits, tools of your trade up to a limit, even school books and clothing. The idea is that collection should not leave you destitute or unable to work. Your principal residence, the home you actually live in, gets its own special protection. As a general rule, the IRS cannot administratively levy your main home the way it can grab a bank account. There is an extra gate in front of it. And for smaller debts, the door is closed entirely. Here is a concrete line worth remembering. Under federal law, if the levy itself is $5,000 or less, real property used as a home, including yours, is completely off limits. The trigger is the size of that specific levy, not your total tax bill, though in nearly every real case the two track together. Either way, the IRS cannot take your home over a small balance. That rules out the scenario people imagine most, losing the house over a few $1,000s in back taxes. That is not a thing that can happen. So, the home is not just another item on the seizure menu. It sits behind an exemption, a dollar threshold, and, as we are about to see, a gate that no other asset has. This is the step even the IRS cannot skip on its own. For nearly everything else, the IRS levies on its own say-so. An agent signs off, and the bank account is frozen. But to seize the roof over your head, the IRS has to leave its own building and ask a different branch of government for permission. It has to go to court. By law, the IRS cannot force the sale of your principal residence unless a judge or magistrate of a federal district court approves the seizure in writing. Read that again. A federal judge, someone who does not work for the IRS, has to personally sign off before your home can be sold out from under you. It is the one asset where the tax collector does not get the final word. This was not always the rule. Congress added it in the Internal Revenue Service Restructuring and Reform Act of 1998, a law passed after years of hearings into aggressive and sometimes abusive collection tactics. Lawmakers decided that a person's home was different in kind and that no single agency should be able to take it without a judge in the loop. In that court hearing, the judge is not relitigating your whole tax dispute. That fight happens earlier, but the government still has to show the court that the tax was properly assessed and is genuinely still owed, and then answer a narrower question. Is seizing this home actually appropriate? Have you been given your rights? Is there a less drastic way to collect? Are the government's interests balanced against the reality of putting a family out of a house? The IRS has to justify the nuclear option to someone outside its own ranks. On top of the judge, there are layers of internal approval. A frontline agent cannot decide to take a home. The recommendation has to climb the chain to senior managers, with legal review along the way. Between the exemptions, the dollar threshold, the hearing rights, the manager sign-offs, and a federal judge, seizing a principal residence is buried under more process than almost any other government action against private property. So, put the fear back together with the facts. Can the IRS take your house? In the narrowest technical sense, yes, it is possible. For a large, long unpaid tax debt, after notices, after a hearing, after internal approvals, and after a federal judge signs an order, a principal residence can be seized and sold. The power exists, and it is real. But look at how far down the road that is. It is the last stop, not the first. And after all that process, home seizures are genuinely rare. The IRS collects the overwhelming majority of what it is owed through liens, payment plans, wage garnishments, and bank levies. Physically taking and auctioning someone's home is expensive, slow, and reputationally toxic, so it is reserved for a tiny number of cases. And even when a home is sold, the IRS does not get to keep the extra. If your house sells for more than the tax debt plus the costs of sale, that surplus is yours to claim back. The government is collecting a debt, not confiscating your net worth. The goal, at least on paper, is to be made whole, not to profit. It is worth being fair to both sides of this. The IRS's power is broad because tax collection funds everything the government does, and a system everyone could simply ignore would collapse. At the same time, The layers of protection around a home exist because lawmakers recognize that losing your house is not like losing a bank balance. The law tries to hold those two truths at once. If you ever actually face this, the practical lesson is the opposite of panic. The dangerous move is to ignore the letters, because that is what forfeits your 30 days, your hearing, your payment options, and your leverage. The people who lose the most are the ones who never open the envelope. The process is slow and full of exits precisely so that you can take one. So, the nightmare version, the surprise afternoon, the changed locks, the house gone over a small unpaid bill, is not how the law works. What is real is a long, escalating process with your home at the very end of it, gated by exemptions, a dollar floor on the levy, hearing rights, and a federal judge. The IRS is powerful, but your front door is the one place where, by law, it does not get to decide alone.